In this week's video, we'll review the latest charts and data to help us answer the question, do recent signals mean the bear market is over? We'll be moving very quickly, so feel free to use the pause button on your video player. Chart that we covered on June 24th said tech relative to the S&P 500. Back then, you could make an argument this was the best look that we had at any point after this peak here in Q4 of last year. This is a slide from the July 1st video where we talked about the accumulation strategy that we've been running. A lot of news this week, including fears of a recession. Probably the biggest development of the week is this chart as of the close on July 29th. This is interest rates breaking down out of a multiple week consolidation box up here. And market expectations for Fed policy have shifted to a possibility of a pause in December. The base case is for a 25 basis point hike in December. And it's also possible the market's looking out into the spring of next year that the Fed could be cutting rates as early as Q1. It's a chart from last week's video dated July 21st. Last week we pointed out that NASDAQ 100 stocks greater than their 50-day moving average hit the highest level for the entire year of 2022, telling us to keep an open mind about something possibly changing. And we covered this study based on NASDAQ stocks greater than their 150-day simple moving average last week. Told us to keep an open mind about much better than expected outcomes looking out 1 to 5 years, and that our drawdowns could be relatively muted. Bullet points from last week. One of the keys was we needed to be open to a longer-term thrust coming this week. But last week we said we really didn't have anything like that yet. Not sure that we can make that argument anymore. The 10-day moving average of this breadth indicator was down below 20. We said we really needed to see more. It did move this week. And in all of these cases here, the low was in dot-com bust bear market. We did have a significant retracement, but the low was in 2002, 2003. The low was in here. You avoided that Q4 drawdown into the spring of 2009, so it takes the 2008 case, at least using this data, off the table. Here, you move from here to here. The low was in after the Christmas Eve low, 2018. Similar move from point A to point B after the COVID low. Doesn't predict anything, it just speaks to probabilities. You can pause your video player here. This is a similar look. You can see with this indicator, breadth indicator makes a high here after that low in late 2018, exceeds these levels here after the low in 2020, the COVID low. And here we just made the highest reading, or printed the highest reading for all of 2022. It's a weekly chart. We conducted a study as of the close on Thursday. This indicator improved on Friday, so this signal is intact at the end of the week. Here we moved from these levels down here to here. In this case, the major low was in 2002, major low was in 2009, major low in 2011. The low was in 2016. You missed this drawdown here. Christmas Eve 2018 and the COVID low, similar move here. Might be helpful to know, how did the stock market perform after this point here and this point here, which is similar to this point here. In every single case, the stock market was higher 3 months later, 6 months later, 9 months later, 1 year later, 2 years later, 3 years later, 4 years later, and 5 years later. 2011 case, you did have almost a double-digit drawdown, but the average drawdown was approximately 4%, the median closer to 3%. It's another form of a breadth thrust that was triggered. This is Dean's work here from Sentiment Trader. Here are the Twitter handles. You can pause your video player. This signal was triggered on Friday. You can see the returns for the S&P 500 looking out 1 month, 2 months, 3 months, 6 months, and a year. Favorable, 100% of the cases higher 6 months out and 1 year out. We took Dean's dates here, figured out the maximum 1 year drawdown for the S&P 500. Extremely muted. The average 2.2%, the median less than 2%. Even the two worst cases were very palatable for an accumulation strategy. You can see Dean's bullet point here when he isolated bear market instances where we saw a similar signal since 1950. The S&P rallied 100% of the time over the next year. If we take these drawdowns and put them on a chart, and in this case we were using Thursday's close as the line in the sand, but this is a good approximation. If history is any guide, and we have a similar outcome in the present day, that would say the low is in. It's not a prediction in any shape, form, or fashion. It just speaks to odds. Back to the bullet point from last week, said we needed to be open to longer-term thrusts coming next. Here are two more examples shown on your screen here with favorable outcomes for the S&P 500, typically looking out 1 year. In the 2022 case, using this indicator, we just moved from point A to point B. Similar moves in the past, and we're showing every one of them going back to 2001, all of the data that we have. All of them came after the major low, with one exception, the 2015-2016 case. But even then, if you ran an accumulation strategy on this pullback, it worked out extremely well. Very similar to the concepts that we covered last week. Remember last week we had a lot of, this is the first time we've seen this in calendar year 2022. First time we've been able to clear the center line on the Bollinger Band, and the center line is turning up. The probabilities are improving. In the markets, you never have an all-clear signal. Here's something that we'd like to see. We'd like to see NASDAQ new highs minus new lows improve. We do have this on the weekly chart. You can see there's a big divergence here when the S&P 500 makes the major low in 2009. You can make an argument we just had a similar and large divergence when this low was made here. Earlier in Friday's session, you can see right after the open, we did have more new highs than new lows, but by the end of the day, that ended up coming in somewhere around a negative 28. So we still have some boxes to check. This is one of them that has not been checked yet. And even if we get that, it doesn't necessarily guarantee us anything. It just makes intuitive sense. If a low is going to be in, this data has to improve. The point is, if the data improves, it doesn't necessarily mean the low is in. NASDAQ 100 breadth indicator weekly held near logical levels here. This looks different from anything we've seen looking in the rearview mirror. This is the weekly version as of Thursday's close. A similar look with the daily version, but it looks like we're trying to do something different in here relative to this downward sloping trend line. NASDAQ relative to the S&P 500, this looks better than this. This looks better than this. Last week we said we had not seen this during the entire calendar year. This looks encouraging from an intermediate to short-term perspective, as does RSI down here, holding above 50. Thus far, that cluster for the NASDAQ and the NASDAQ 100 that we were using as a guidepost has held. A common theme this week would be if we rally, we will run into potential resistance, but you can see even if we just make it back to this trend line, that's a big move left before we test this area here. Not a prediction in any shape, form, or fashion. We continue to hold and make an impressive stand near the upward sloping 200-week moving average. See momentum turning up here, and we're holding on to that secular trend look as of the close on July 29th. You can pause your video player here. Moral of the story, we'd like to see weekly RSI for the NASDAQ get above 60. We're not there yet. A nice little hurdle here. Here's that cluster from 2020 that we've been looking at. We've exceeded this high here, and we've exceeded this high here. The longer that remains in place, the more relevant it becomes. This is also that nice look down here on a relative basis, NASDAQ relative to the S&P 500. During Friday's session, the broad Dow Jones Composite average in terms of sectors cleared these levels here. The longer it's in play, the more meaningful it becomes. We've also cleared this downward sloping trend line. Economically sensitive travel and tourism up roughly 5% for the week, and trying to make a stand at this gap area that we've been watching. Here's a signal that was nailed down on July 21st, point A to point B. In the historical cases, the market was higher. In every case, 1 year later, 2 years later, 3 years later, 4 years later, and 5 years later. Average and median drawdowns align with an accumulation strategy. This is a month-end chart now. We're at an area trying to make a stand where the market has made significant stands in the past. This is a breadth indicator on the bottom. NASDAQ 100 stocks greater than their 200-day moving average. The longer we hold above these blue lines, the more meaningful it becomes. See, during this uptrend here, for the most part, we stay above the upward sloping 40-month moving average in red, trying to make a stand at that level in the present day. This is Thursday's close here. We exceeded this downward sloping trend line during Friday's session. Thus far, NYSE Composite also trying to make a stand near that logical upward sloping 200-week moving average in red. That same broad NYSE Composite, hard to make an argument that making a stand here near this COVID high and near this area and here that acted previously as support, hard to make an argument that's not a logical place for a double bottom look. This is a double top look here in the same general area. You can pause your video player here. This look in the present day looks more like this favorable case near a major low in 2016 and currently looks more like this favorable case near the end of a correction in 2010 relative to this unfavorable look in 2008 and this unfavorable look in 2001. The longer this look holds, the more relevant it becomes. The look of the lower Bollinger Band and the center line are also relevant when comparing cases. Looks better than anything that we've seen in calendar year 2022. This general area acted as support. It acted as resistance, 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 trying to clear that level, and we cleared this downward sloping trend line. Want to make sure we're taking a balanced look at the data. Improvement over here. That leaves the door open to this drop here before the final low in 2009. This looks better than at any point during the calendar year relative to this trend line. Still has some work to do. Price action above an upward sloping 50-day in blue here looks better than anything that we've seen in calendar year 2022. One possible scenario is the S&P rallies back to this downward sloping trend line somewhere in the neighborhood of 43 to 4,400. All things being equal, if you're a stock market bull, you would like to see on this 60-minute chart, this 600 period moving average, you'd like to see us get above it, and you'd like to see it turn back up. This was that look from last week. Momentum here in June and July looked better than anything that we'd seen in 2022. Very impressive that the S&P 500 has cleared these gigantic gaps here. The longer we hold above them, the more relevant it becomes. Daily MACD above the zero line, all things being equal. If you're a bull, that's what you want to see. The hypothetical drawdowns on the 2-quarter decline study that we covered previously tells us to keep an open mind about additional drawdowns into these areas here. Also tells us to keep an open mind about no additional drawdown relative to this level here. Another very impressive chart. S&P 500 weekly closed well above this gigantic gap here. Bullish cross down here on MACD. You can study this chart here. Black ADX turns down near the low in 2008, 2009, near the low in 2010, near the low in 2011. Black here above red and green turns down early 2016, telling us that the downtrend is getting long in the tooth. Turns down here Christmas Eve, turns down here near the COVID low. Weekly ADX black has been rolling over above red and green. Speaks to odds. Covered this last week. Weekly looked better down here than anything that we had seen. It still does. can pause your video player here. This indicator still has some work to do. We'd prefer to see it get up here. We're not there yet as of Friday's close. Here's another one that's encouraging. This takes that drawdown in 2009 off the table, hypothetically, relative to history. You can see from here, you move from the lower purple to the upper purple. That's after the major low in 2009. Similar move here in 2002, after the low in 2011, after the low in 2018, 2019, and after the COVID low. We just made a similar move in the present day. In the 2011 case, you did move from here to 35.2, and then you reversed and had another drawdown. We closed above that on Friday at 36.8. In every single one of these cases, when you move from the lower purple line to the upper purple line, the low was in. Here's another chart that looks different relative to anything that we've seen before, during, and after the topping process. The NASDAQ peaks in November of last year. This is the first time we've had a weekly close below this upward sloping trend line. How about our updated scores? Remember, these scores are based on this data shown on your screen. We want to get to this type of return, but we don't want to jump the gun. And we'd like to avoid that 2008-2009 additional drawdown. July 8th, we could only clear 0.83% of the bullish hurdles. Last week, 4.67%. This week, quite a bit better at 14.59. XLK, in the same system, scores 25.29. And maybe more importantly, IEF is up to almost 34, and this speaks to the probability of interest rates peaking. Still have work to do here, but we're making progress as you would expect. If the low is in, these numbers should continue to get higher in the weeks and months ahead. There's a high yield fund down here. When you recaptured the 200-week, it was after the major low, after a major low, after a major low. If we look at the HYG high yield ETF, it's trying to recapture this week. This is 2:20 p.m. on Friday. It was above. The longer it holds above, the more meaningful it becomes. This speaks to the credit markets, credit risk, and perceived liquidity risk. July 29th, 2:14 p.m. looks better than anything we've seen during the entire calendar year. Remember, a couple of weeks ago, we said we had that bearish divergence down here. Here was the look. On July 14th, we said to clear the divergence, we needed to fill that space. We've done that, and we're even better than that. We've cleared the trend line down here. We're seeing progress. Not everything is perfect. Still work to do here. IWM, still work to do here. We came back to this gap and held. There's still a gap down here on a pullback scenario, all hypothetical. Investment grade corporate bonds, LQD, in the ETF world looks better than anything we've seen in calendar year 2022. Momentum ETF, trying to make a stand at a logical area here near the COVID high and near this point in here, or the cluster that we've been talking about. 50-day moving average trying to turn up with price above it at the moment. This is QQQ during Friday's session. This is QQQ monthly at the end of the month, QQQ relative to SPY, trying to make a stand at an upward sloping 50-month moving average. The weekly relative to the trend and potential resistance relative to SPY still has some work to do. This is a common theme on many charts. It's subtle but important. Here, the 50-day moving average, we go above it. We can't make a stand when we come back to it. In fact, it ends up acting as resistance. Quite a bit different here in the short run. We go above it, we come back, we tag it and test it, and now we've made a higher high. This looks quite a bit better than this. Subtle, but relevant. Subtle, but relevant. This is Thursday's close. Equal weight technology peaking above a downward sloping 200-day moving average for the first time in quite some time. SH this week below this upward sloping trend line. High beta at the end of the month relative to SP low volatility. High beta won the month by over 10%, trying to make a stand at a logical level. Here's a ratio that we were concerned about a few weeks back. Looks a little bit better today. If you pause your video player here, this is an improved look between SPY and GLD on the monthly chart. At the end of the month, we also recaptured this level here and this level here. Still some work to do here, but this is the best look that we've seen, SPY divided by SP low volatility. Haven't seen anything like this for the entire calendar year. This white space here is also encouraging. See the white space down here. SPY divided by XLP defensive. Here's the look yesterday. Here's the look today. Looks quite a bit better. Still some work to do. There's a weekly version, SPY divided by XLP defensive Thursday, only up 0.2% for the week, not very impressive. Had a nice rally on Friday to finish the week up 2.5%. Still some white space here relative to possible backtracking. Tech relative to SPY trying to make a stand at a logical level down here. 50-day moving average trying to turn up in a nice manner here. Covered this many times. Drop below, stocks rally. Drop below after the COVID low, stocks rally. Here we are near the close on Friday. Similar look if we move in this direction. There's a monthly chart. If you want to flip it around, here's the look here on July 28th. Here's the look today on July 29th. Friday, the stock market had a great session here, made a discernible lower high in this ratio relative to this point here. Really got the polar opposite on Friday. This is 2:37 p.m. on July 29th, gapped above the downward sloping trend line. This is really the best look we've seen for the entire year. We've never been above purple here. Here's discretionary divided by defensive staples on July 22nd relative to this trend line. You can see we're below it. This is what we looked like at the end of the month. More signs of increasing risk appetite. Bullet points from May 20th. Probably fair to say we've seen some improvement here. We've seen some improvement here. We covered it in this week's video. We've seen some improvement here because the economic data is weakening, which is telling the market that we may be getting closer to a Fed pivot, a serious pivot. This is really what we've seen so far. June 24th video, we said based on history alone and declines, you could make an argument that there was a 75% probability we were near the end of this thing and about a 25% probability historically that declines would get worse. This type of argument still holds. We have seen this here. We've seen this here. Definitely have seen this down here. And since June 24th, the data, for the most part, has allowed. If you remember the COVID low or any low, it's never going to feel like everything is fine. There are always bulls and there are always bears. Even if the low is in, it's still going to feel unsettling at times. To summarize, on June 24th, we talked about the fact that the odds were improving a little bit. They were even better on July 22nd, and the odds are even better today. Thus the adjustments to our allocations. We had some of this a week ago. We did not have this. Now we do. Even if, and the key term is if, the low is in, a 2 to 10% pullback would not be abnormal. Let me repeat that. Even if the low is in, a 2 to 10% pullback would not be abnormal. Some of the data leaves the window open for the 2008 type case. That says it's possible, probably not probable at this point, possible that we could still see a 20% drawdown from where we closed on Friday. And possible relative to the data means we still have to respect it. Continue with our accumulation strategy as long as the data allows. If it doesn't allow, then you stop accumulating. A lot of unknowns and wild cards left on the table. Trends have improved, but they still need to take additional steps. Still need to see more on this front here. And for us, relative to our approach, it's important that we stay within the bounds of the data and our risk management approach. It's always a balance between risk and reward. And as always, the comments and commentary in this week's video are based on the facts that we have in front of us. If the facts change, then we have to be willing to reassess those odds. And we all know the only way any of this works is if we head into next week and every week with that flexible, unbiased, and open mind. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shivako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.